You get a raise, and someone at work says, "Careful, if that bumps you into the next tax bracket, you'll actually take home less." That is the most repeated money myth in America, and it is completely arithmetically false. A raise cannot lower your take-home pay. It is not possible. And the reason why is the single most useful thing you can understand about taxes. So let's build the whole machine, piece by piece. Start with your paycheck. The number in your job offer is not the number that lands in your bank account. Between those two numbers, money is removed, and most of it is removed before you ever touch it. Your employer sends part of your pay straight to the government on your behalf, every single payday. That's called withholding. You never hold that money. It's gone before the deposit clears. So by the time you file a tax return in the spring, you have already been paying taxes all year. Filing isn't when you pay. Filing is when everybody checks the math. Hold on to that. It explains something surprising later. Next, the government does not tax every dollar you earn. It starts with your total income for the year. Then it subtracts an amount that it simply agrees not to tax at all. Most people take a standard version of this. One flat number, no receipts, no paperwork, applied automatically. Say you earned $50,000 and the ignored chunk is $15,000. That leaves $35,000. That smaller number, not the 50, is what actually gets taxed. The exact amounts change every year, the shape never does. Total income, minus the part that's ignored, equals the part that counts. Now the part everyone gets wrong. Picture a row of buckets, each one bigger than the last. The first bucket is small, the second is bigger, the third bigger still. Your taxable income gets poured in from the top. It fills the first bucket. When that bucket is full, the overflow runs into the second. When that one fills, the rest runs into the third. Here's the key. Every bucket has its own tax rate, and that rate only applies to the money sitting inside that bucket. The first bucket might be taxed at 10%, the second at 12%, the third at 22%. So if your income just barely reaches the third bucket, only the few dollars that made it into that bucket pay 22%. Every dollar behind them is still being taxed at 10 and 12. Nothing moves, nothing gets recalculated, nothing gets punished. Which is why the raise myth is false. A raise adds a few dollars into a higher bucket. It cannot reach back and re-tax the dollars underneath. Earning more money can never leave you with less money. This is also why the bracket people quote is misleading. When someone says, "I'm in the 22% bracket," they do not pay 22% of their income. That's just the rate on their last few dollars. The top bucket they reach. Add up what they actually paid across all their buckets. Divide it by everything they earned, and the real figure is meaningfully lower. Almost always. There are two different numbers, and people confuse them constantly. The rate on your last dollar and the rate on your whole year. Only the second one is what you actually pay. Now back to that thing I told you to hold on to. All year, your employer has been guessing how much to withhold from each paycheck. If they guess too high, you overpaid. And in the spring, the government returns the difference. That's a refund. It feels like a windfall. It isn't. It is your own money coming back to you after the government held it for a year without paying you a cent for the privilege. And if they guess too low, you underpaid, and you owe the difference. A big refund is not winning. It means you lent money, interest-free, to the government, all year, by accident. One last distinction. Because it's worth real money, a deduction shrinks the income that gets taxed. A credit cuts the tax itself. A $1,000 deduction removes $1,000 from the pile before the buckets. Depending on your bracket, that might save you a couple $100. A $1,000 credit comes off your tax bill directly. That saves you $1,000. Same headline number, very different value. A credit is almost always worth more than a deduction of the same size. So that's the machine. Money comes out before you see it. A chunk of your income is ignored. The rest pours through buckets, each with its own rate, and only the dollars inside a bucket pay that bucket's rate. The bracket you quote isn't the rate you pay, and your refund was always your own money. Taxes aren't confusing because the arithmetic is hard. They're confusing because almost nobody explains the shape of the thing before throwing numbers at you. This is general education, not tax advice. The exact figures change every year. And if your situation is complicated, talk to someone qualified.